From the morning reading, oil gives back Friday's gains. Stocks move down on lower volume. Apple reports on Tuesday after the close. All nine sectors moved lower on Monday. XLU, XLP, and XLV were the strongest sectors, while XLE was the weakest sector. Oil fell $2.45 to close at 29.80, giving back Friday's gains. Breath weakened as decliners led advancers 5.44 to 1 on the New York Stock Exchange and 3.01 to 1 on the NASDAQ. The SPX breaks below Friday's low following two-day rally as oil pulls back. Potential hedge and bear flag entry day on many charts. Volume was lower on the SPY, Diamonds, QQQ, and IWM on Monday. McDonald's hits new all-time intraday high following earnings. PG, J&J, DD, and MMM report before the open on Tuesday, and Apple reports after the close. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:53 a.m. Central Time, and I'm recording this in preparation for the market day of January the 26th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report and a little bit of action, generally positive. All four the broad market indices are currently up, though this has been moving around in the overnight. Currently, the S&P futures are up about 1/3%. Russell futures up just a bit more than that. And the NASDAQ and Dow futures are also up about 1/3%. Crude oil is up about 1.1%. Euro is down marginally. Bonds are scratch. And gold is up about 2/3%. Most of the action is coming from overseas, especially China. China got crushed, down 6.4%. Hong Kong down about 2.5%. Japan down almost 2.5%. Though in Europe, a little bit different picture, with Germany essentially scratch and the United Kingdom just below scratch. In terms of macroeconomic reports for today, fairly simple. We have one red flag report, but this is during the cash market open, and this is consumer confidence. You also have coming up for tomorrow the weekly variety of crude oil inventories, and then the FOMC statement and federal funds rate. So it should be interesting to see what might come out of that. So be aware of that on tomorrow. That could absolutely be a market maker. I should also mention new home sales will be out tomorrow. In terms of current volatility conditions, obviously with yesterday's action, the volatility rose a bit. Short-term VIX now up to 26. Skew remains elevated. IV percentiles below, the annual mean, and yet at the same time, nothing particularly exciting at this point. SPX, or the S&P, is at a 43, Russell 48, NASDAQ 48, and Dow at a 50. We did have standard deviation moves put in by actually it shows 3 here, but it was actually all 4 of the broad market indices yesterday did have a standard deviation move after several days without a standard deviation move between the close to close. Let's go ahead and take a look at the charts, and you'll see as we zoom into the most recent pattern that we've had indeed this last week, the reversal, which confirmed, which broke the diagonal, but did not get up to the 10 EMA. And then yesterday, I guess technically, it's right there at the same place. This is probably going to be called a dark cloud cover, but a big reversal pattern, totally obliterated the positive action coming out of Friday. So this looks very, very weak, and a close below 1880 yesterday probably signals that we are going back towards the bottoms. So we'll see where today takes us. We're having a bit of a positive inflection at this point, but this is decidedly a weak pattern, and the primary probability is that this is going to be, when we look back at it down the road, that this will be a bear flag and that this was a rollover and we're going back down to the bottoms. Of course, new news could change that, and certainly with the Fed out there tomorrow, that could be very much a potential. Also, I would mention like the Apple earnings after the market today, after the market closes, and other earnings that are coming in this week. This is a huge week for earnings, and some of these companies absolutely have the ability to move the market and influence the direction, and that could have an influence just where this pattern fills out. But primary pattern expectation at this point is a bear flag, and that we would continue to move down. In terms of the NASDAQ, also big bearish pattern yesterday. Let's zoom this thing in where you can see what you're talking about here. The Dow, again, big weak pattern. And then the Russell, which has been the weakest with a total breakdown, also obliterated that diagonal breakout. Just basically at this point, that looks to be a kind of bounce and false breakout, I guess we would call this, and then back down. Let's go ahead and look at volatility. This is futures, so this includes today. You see yesterday, big reversal. Though, interesting enough, volatility did not come all the way back to where it had fallen from on Friday. So the volatility response to yesterday's action was relatively muted. It also should be said that volume on the four indices was also relatively low. In relative terms, so kind of keep that in mind. So it wasn't like there was abject fear, but at the same time, that was clearly weakness. And then let's take a look at bonds and we'll wrap this up. So bonds continue on this short-term trend. You might even call this a bit of a channel to continue to climb up. And that certainly is not a healthy sign for the bulls and the equity markets. Now, if we get past this area here, this 161.17 on the /ZB with the long bond futures contract, that probably means that we've probably broken out to the new lows on the equity market, and we have cash flying towards safe haven status. So going to be kind of interesting to find what happens here. Is equities, if they should, fall down and fall into the prior support area, and bonds come up into the prior resistance area, do they break? And you may if you're trading one, follow the other to see if that's being confirmed to your action. And then, of course, the last place to look is for the futures and see if we're making higher highs on the volatility futures and see if you're getting confirmation there as well. The reason you want to do that is if you're not seeing confirmation, what you could see is a third possibility. Is there, there's down, there's up. The third possibility is that we just kind of chop and go sideways in a bit of a range, and that's a very distinct possibility that we may not actually break these lows around the 1812 and 1800 area, that we may just simply chop around in a new range and reset, much like we've done so much of recent months, and basically going from one range to another until you break out, and then you form another range, and then you break, and then you make another range. We've spent an awful lot of time recently in essentially range bound. So let's go ahead and go to the daily report. No changes here of yet. The market trend intermediate term phase opinion is still phase one, which is bear flag reversal, fat toe in the water. Typical description is out of the money puts and reduced stock positions. we were looking for the conditions to make this phase two. Well, that certainly did not happen yesterday, so we are solidly in phase one. In terms of our mechanical signals, in terms of the portfolio investor posture, market and correction still in place. Accumulation distribution in the S&P, a woeful E, as is NASDAQ, also an E. GMI index, a solid 0 out of 6 with the sell signal since 1210, and that author happily 100% in cash. And I should say that I've read, a number of people that I follow that are very, very heavy in cash right now. And, it depends on what kind of style trader they are, whether they're a stock trader or they use other alternatives as well. But with respect to the people who are generally stock in their portfolio, there's some very, very heavy cash holdings amongst the number of the people that I follow. In terms of decision point scoreboard, no changes here, but decidedly ugly. And the consensus of all these signals is that we are a market in transition still, with the potential to move to the top of the range or to the bottom of the range, but yet clearly a very, very heavy bias to the bearish. Indeed, with the intermediate term market posture, we had a technical signal first day bullish, but a very poor candlestick pattern to go along with that. Also, disagreement from the other indices, and we still have a very bearish sentiment line. So at this point, I'm going to call this a first day bullish whiplash and false breakout. We'll see if that indeed flips back over or not. In terms of the position sizing opinions, both opinions are still quite defensive, with the one based on portfolio position at 0% and the volatility-based system at less than 50%. Here you see the intermediate term market posture, and we did have two of the indices, the S&P and the NASDAQ, of course the S&P being the most important, go to first day bullish. At this point, though, they look to be a first day false breakout. The Dow and the Russell both improved, but are still in the very severely bearish camp. In terms of hedge warning status, we retain our crash level warning status, threshold level 3. This means that there is the potential, but not the promise, that we could have a significant down move in the market. The risk parameters are clearly there. In terms of short-term and medium-term risk to equities, neutral on the short term. On the medium term, actually relatively low at a 3. In terms of the specific metrics, the volatility base, we've got a lot of warnings here still. Market decline, sharp increase warning. The sharp increase warning had come back with yesterday's action. The VIX futures up over 18, distribution day count in the market and correction status. The VIX phase with an increasing skew continues to be elevated, about 5 times the normal probability for a 2 standard deviation move within the next 30 days. Current week out expected move in the SPX, still a very high 67. We also have, in terms of new highs, new lows, very benign level. We talked about the relatively weak volume in that down move yesterday, and this was one of the things that, the bulls need to look for signs that, that all is not lost. You might look at something like this to where many of these did not set new lows. Of course, the intermarket risk aversion indicators, we still have one as risk on, just barely hanging on by the skin of its teeth, and the other 4 still flagging as risk off. Fear and greed index at a 15, so slight improvement over the day before, which was a 13. In terms of special opinions, no change from yesterday. In terms of option income strategies, cover calls and put selling outside of the acceptable window for novice traders. Aggressive traders should continue to use some of the suggestions here to remain very, very nimble and reduced risk exposure, while perhaps taking some position, taking advantage of this increased volatility. Sector market posture, sector specific, you see we have quickly returned to a sea of red with only utilities holding up as relatively well performing. In terms of percent change, again, everybody was down yesterday, including utilities. So let's not get, while utilities has held up really well during the recent weakness, as you would expect, a defensive sector, that does not mean it's necessarily positive. So even utilities can have some negativity if the bear market bears down on all the sectors. And I think that's probably enough for today. And just quickly here, a couple comments. If you'd like to get emails, and this gives you a limited number of emails, I don't pound you at all, probably an average of about one a week. Most likely emails coming when I have alerts to the hedge risk level changes, but I also have periodic blog articles and other items of interest. Two ways to get on the email list. Go to this website address, roll down a little bit, you'll see this button, click on that button, fill out your name and email address. That'll also get you a copy of my ebook, Portfolio Strategy. The other way you can do this is you can text Falcon Global, all one word, no spaces, to the number indicated, and that will also get you signed up for the email and also get you access to the ebook. If you find that what you're getting from here is helpful to your trading, we would suggest that you subscribe to the YouTube channel. That'll give you an alert when content has been posted each market morning. Also, you can like us on YouTube, and that's frankly the way you pay us, as it were, because all this is free on this morning market preview. But we do very much like the acknowledgments from YouTube, or where you retweet to your Twitter followers, to your StockTwit followers. That is our pat on the back that you're finding what we're doing is helpful to your trading. And we'll just scroll through the rest of this today. I think I've gone through enough extra. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you can see the full hyperlink near the bottom here. And if you click on that hyperlink, that'll take you to the full set of legal disclosures. In the meantime, we'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.